we're still at a premium. So I'm going to show you how we can use the PD array matrix to map out a premium to discount market in a implied dealing range. This is the part where you take notes, folks. All right, so we're zoomed in that same area here, but now on a 1-minute chart. This is the PD array matrix and the range I'm using here, so that way you can do it on your own charts, not just simply take my chart and think you've done the work. From this high down to the 41.46 even level. Now, why am I referencing that? Because that's the target I told you the price was going to go to today, this morning on Twitter. It's going to return back to what? The new week opening gap. It's going to be like a magnet, folks. It's going to want to draw back to that. Why? Because for the week, for the entire weekly candle, from between the highest high and the lowest low, if it's not a trending market, what's it going to do? It's going to treat the new week opening gap as fair value. And it's going to want to revert back to that continuously. And that allows for new sentiment to come in. Oh, it goes back to that gap. Okay, a lot of algorithms, not the algorithm that's the price engine, but the algorithms that operate on the fund level, they will likely use that opening gap to constitute their new trade idea based on a new sentiment idea, because it trades back to it. Much like I'm teaching you to view it as what? Support and resistance. So if it's up here, and I'm telling you all, focus on 41.46 because it's likely to pull back to that weekly gap that opens on Sunday. What's the nearest price above the gap? It's the Friday's closing price, which is 41.46. So if that's the level we're looking for price to go to, and we're above it, and we're looking for lower prices, we create a high here. It starts to pull back and go below the high here and the relative equal highs that we've had now 4 times. Remember the slide before I went to this one? 4 times it banged into that level, and then we hit it here and then started to sell off. Where are we at when price is trading right here? Are we in the red area, which would be considered premium relative to the high, to the target where we're looking to trade? We're looking for the draw on liquidity, the terminus. Where is it likely to go to? Remember, that's the thing I'm teaching all of you to focus on. The part of this puzzle is not knowing where it's going to next. And you're focusing on all the order blocks and what fair value gaps and when they're they staying open. You're missing the whole entire plot. You have to be trained this year. Use this time with me to understand why I'm teaching you how I'm teaching you. Where is it likely to go to next? Because all that question of what you're looking for and why it does this and shouldn't do that, that becomes much easier to figure out when you know what the market's likely to do. And also, if I don't know what I'm doing, I won't be right, will I? It means there's no algorithm. That means there's no way that there's an algorithm. And you see it and you understand it, and you'll understand what each candle means each time it creates a new one. It falls into place into a storyline. The storyline is they ran the buy stops above those highs. Ran it right up in there. Broke lower. You already knew 41.46 was where we were looking for the draw on liquidity. I guarantee you, when you were seeing this rally up here, you're like, oh, ICT got it wrong. I'm not gloating. I'm just telling you, I see this happening. It's like I'm reading all of your minds with these candlesticks. When this thing starts to break down and we have a target, 41.46, you need to take your high, if you're short or if you're looking to be short, the high that forms that you think is a suspect high. A suspect high is a high that's been blown out, and you want to see if it maintains the rejection. So we don't know if this high is going to be, well, taken out, if you will, until we trade from premium to discount. We have that right here. Then the market does what? Returns back up into a premium. I'm scrambling to get Camtasia open right here. Finally it gets open. I get my chart open, and then right here. What's occurring? Look closely. I've already shared it with the Twitter community and actually showed an execution. So I traded this, not just simply me talking about in hindsight. So you can look at the video on YouTube. I'll take the annotations off in a second, but look what we have here. We have the high to 41.46 even, which is the Friday closing price, which is the high end, the top of the new week opening gap. With that price level as a magnet, if price is up here relative to that target and the high is here, if we go short in here, we're shorting what? At equilibrium or premium. Either one is okay. But you can't go in and start pyramiding once we get down into here. Because once we start crossing into the halfway point of the discount level, you're too much in a discount to add more to it, which is the reason why you see me do one and done, and there it is. Yeah, I got in. There was no opportunity for me to pyramid. It was just a straight shot, 41.46. Thank you very much. Wham, bam, thank you, ma'am. But let me take the annotations off, and you can see. Pay no attention to the fact that the standard deviation 1 takes us down to that really nice low. But that's just extra, no charge. So here's the level. That's equilibrium. Do you see the volume imbalance right here? I've been teaching it. That volume imbalance is at equilibrium and then a very small premium. My entry was short, instantly delivered. This type of movement right here, that is exactly what a low resistance liquidity run signature performs like. Now, do you want to be in a move like that, or do you want to be in a move like this? Buying down here, hoping it gets to this level up here. Buying here, riding it, rolls all the way down this deep against you, rallies up. Okay, it's going to give it to me. It's going to give it to me. Nope, it rolls back against you. If you put your stop here, you're taken out. Then it rallies up here, but you've been taken out. But it went to your target. That still happens to me if I trade in high resistance liquidity run signatures. I can trade in them, but it doesn't give me peace of mind. I don't want to be in a trade that has this roller coaster back and forth and still gets to where I think it's going to go. There's other days to trade where I won't have that, which is how I teach my students to trade. When we get in, we're looking for very quick responsiveness in price. We want to see instant feedback. We want to see how price goes right to what we're looking for. We don't want to be messing around. We don't want to be sitting around worrying about twiddling our thumbs, hyperventilating, huffing and puffing, cussing, cursing the market. I've been there, folks. I put my fist through several monitors over my career. I've done it. I don't do that anymore. It's boring to me. If I got it wrong, I got it wrong. I'm not going to lose my mind over it. I know what I'm looking for. In the future, it will repeat. It just means I've done something incorrect. And I assume that responsibility as a trader. But you won't hear that in books. You're going to hear people say, push your edge. Don't worry about the drawdown. Trade your way out of it. Everything that's wrong. That's what's promoted. And there is a logic to look for opportunities that deliver instantaneously, powerfully, energetically. And it repeats over and over and over again. Look closely. The volume imbalance here. Why am I even looking at that? Because of everything I just outlined, how fast we move from this high. It's not likely to do what? Come back up to any of this imbalance. It's showing us what? Volume imbalance here, a fair value gap, another fair value gap, another volume imbalance that did what? We traded up into it here with that little bit of a wick, and we went down into discount, halfway between the high here and the target of 41.46. Here with that little bit of a wick, and we went down into discount, halfway between the high here and the target of 41.46. This returned back into that volume imbalance right there. That's it. That's the last bus stop. And then we're out of here. Elvis left the building. And here we have it, delivering right where I said it was going to go. When nobody else up here was expecting that price there. So the narrative was run the buy stops, accumulate that as a short position for smart money. So the composite man sells short to the buy stops and buys the sell side liquidity. to cover the short. And the market rallies up to some random level between this candle's low and this candle's high, which is consequent encroachment. That's exactly what you're seeing right here. And the market trades lower. So the market trades down to midpoint, rally, midpoint, sloppy, 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 sloppy. And then between 1050 and 1110, there's going to be a macro.